This is your brain on risk. This is Mind Over Money, the podcast where Kevin Cook exposes the psychology of investing.
Welcome back to Mind Over Money. I'm Kevin Cook, your field guide and storyteller for the fascinating arena of behavioral economics. In the fall of 2009, I went on CNBC for an interview about gold with anchor Maria Bartiromo. The yellow metal had just gotten back above the $1,000 level and was about to make new highs since the financial crisis. My primary theme was to address the reality of gold doubling to $2,000 and higher if it was truly viewed as a monetary phenomenon. In other words, since central banks were engaged in long-term support of their economies and bond markets with measures like quantitative easing, or QE, their balance sheet expansion was in effect like printing money, and therefore the value of gold should go up in relation to that expanded supply of dollars, euros, and yen. My thesis was not a precise mathematical calculation. According to various gold bugs like Jim Rickards or Peter Schiff, the real math could send gold above $4,000. So my idea was not based on what price gold should ascend to, but rather what price could be achieved because enough others believed it should vastly appreciate due to central bank QE and the coming tsunami of asset inflation. For me, it was simply a behavioral bet about what an asset bubble could achieve when a perfect storm of QE and true believers collided. It would also help if global money managers at large institutions were advising their wealthy clients and pension funds to invest in gold as a safe haven, a safe haven asset to protect against the vagaries of competitive currency devaluations. The true believers were all over financial TV and advertising, telling average folks that they needed to buy a hard currency like gold to preserve their wealth. In essence, turning dollars into gold was the safe bet because the former was certain to lose value over time to the benefit of the latter. Sure enough, gold soared for nearly 2 years until the mania peaked just above $1,900 in the summer of 2011. Unfortunately for me, I didn't make any money off that trade because I didn't have enough faith in the idea. It was a good thesis, but I was too scared of the volatility in such a euphoria-driven asset class. There's a lot of psychology behind the value of gold, as we'll talk about. And at heart, I really didn't believe gold was worth $2,000 an ounce. After all, I had just finished a 10-year stint as a currency trader at the Chicago Mercantile Exchange, or now called CME Group, and had internalized the financial revolution that Milton Friedman launched when he helped CME create currency futures in 1971 after Nixon abolished the gold standard. Gold became delinked from the financial system, and there was no going back, especially once central banks proved they could defend the global economy from collapse using fiat currencies. Debt, good or bad, was the lubrication for modern economies and finance. But there was another theme that was even more important than the mechanics of finance, and that was technological innovation. I'd been an eager student of how technology and innovation changed history and civilizations for millennia, but nothing hit me harder than holding my first Apple iPhone in my hand in 2010. How and why, I wondered, should a piece of metal be worth more than this magical device in my hand that could do so much for me? And the more I expanded my knowledge of and investing in companies creating advanced technologies like computer chips and biotechnology drugs, the more I became convinced of what John Maynard Keynes concluded nearly a century ago. Gold was simply an obsolete antiquity, a barbarous relic. Now, I was convinced I could trade gold after the peak, but as a gold bear, shorting the yellow relic using various ETFs, inverse ETFs. And gold went down from above 1,800 to under 1,200 from 2012 to 2015. And I thought it might keep going under 1,000 soon. But in 2016, as we had a collapse in the price of oil and sort of a mini earnings recession for corporations, even though the economy didn't slip into recession, central banks had to restart their QE money printing engines, and gold put up a good fight to spend most of its time above $1,200, which was fine with me because I was so immersed in studying semiconductor companies like NVIDIA and biotech companies like CRISPR Therapeutics that I didn't care what investors did with gold. And in 2017, I summed up my ideas in a special report for Zacks Confidential titled The Technology Supercycle. In that report, I was trying to answer two burning questions I had about the economy that I knew were related to technology and innovation. Number one, why was government productivity data so muted in a world of hyper-speed technology efficiency and disruption? And number two, why was inflation so tame when stock market capitalization and investor wealth were soaring? I dealt with both of these questions by searching for simple, convincing data and reliable economic sources. Once I found those answers about weak productivity and missing inflation, I used them to support my personal theory that we were in the midst of a technology supercycle driven by very advanced areas like big data, mobile computing, artificial intelligence, networks and Internet of Things sensors, and biotechnology. To get a copy of that report, just email ultimate@zacks.com and tell them Cooker sent you. All right. Now, let's talk about my 4-point bear argument against owning gold. My core fundamental argument against gold is that it has little fundamental value. Other than the jewelry business, it generates no earnings or income. In fact, there is a net cost to own and store gold that should bring into question old ideas about it being a store of value. So if it has only minimal industrial utility, a little more jewelry value, and then there is some nebulous part of gold's value that is still related to its old, antiquated role of money, since central banks are printing so much, what's the rest of gold's value all about? It's all about psychology, about the true believers who want to have a hedge against the monolithic banking system and its corrupt bureaucrats that, broke the economy in 2007 and 2008. In the end, when fiat economics collapses, the little guy will win with his basement full of gold bars. He'll triumph. So that's the thesis anyway of a lot of people that we call gold bugs. And if it makes them feel good and that's where they want to put their money, God bless them. But I recently reviewed my anti-gold thesis as a guest on the Market Edge podcast with Tracy Reinick here at Zacks. And we talked about what's reasonable if you wanted to put money in gold. And the number that floats around usually is about 5% of your assets, 5% of your long-term capital, so to speak. Not, rushing out and putting 40% or 50% in gold and gold stocks as some people might recommend. I think the senator from is it Kentucky, Rand Paul? Well, his father is I know owns a ton of gold and gold stocks, and probably Peter Schiff does too. And I think that that's the wrong place to put your money when there's so many better things to do with gold. So the podcast I did with Tracy in September is titled "Gold is Hot. Should Investors Be Buying?" And you can find that just by going to Zacks Podcasts, or you can find the Market Edge podcast on iTunes. I think it was first week of September. Gold is hot. Should investors be buying? So you can listen to that anytime. But I'll quickly summarize my 4 main points right now for you. Number 1, fiat central banking is here to stay. We are not going back to a gold standard ever. And the rise of PayPal, Square, and Bitcoin confirm the primacy of the digital economy. Number 2, technology drives economics and wealth creation. Innovation will always trounce a heavy metal bar that costs roughly $750 an ounce to produce, offers little utility, and produces net costs for storage and insurance, even in a world of low interest rates. Number 3, inflation is best beaten by investing in equities, especially a broad mix of innovative companies creating long-tail revenue streams in technology and in healthcare. Number 4, the global market has spoken. If all of the above were not true, why isn't gold back to new highs already? The market story of the past decade in gold is telling you that investors created a bubble that popped and that even extremely low or negative interest rates cannot get the bubble back. After a break, I'll tell you about a completely new development that has me saying gold is headed to zero. I'll be back faster than you can spell quantitative easing. Well, as you learned in the opening half of the podcast, I'm a gold bear. That means I don't think investors should be storing significant amounts of their savings in the barbarous relic. And I mentioned the podcast. You can listen to me carry on about that with Tracy in our Market Edge podcast. Since that recording was published on September 4th, the gold ETF, GLD, has been down over 5% as of last week. I'm going to share an article I wrote last week. And the title of that article is Why Gold is Headed to Zero and What You Should Buy Instead. Of course, I used a very provocative headline, not just to get some clicks, but because there is a new development since my longer-term thesis, my 4-point thesis that I just outlined in the first half of this podcast, and I talk about with Tracy in her podcast, a new development. And I'm going to share that in a moment. So let me just say that the gold ETF is down. When I wrote this article, Why Gold is Headed to Zero last week, the gold ETF was down about 6%, and my favorite industry was up over 15%, with some key stocks sporting gains of 50 to 75%. And you might be able to guess, based on those kind of gains, what that industry is. I'll cover that explosive sector in a moment, right after I tell you about the recent event that has made me even more bearish on gold and throwing around ideas like gold could go to zero. Astronomers have been studying a large, metals-rich asteroid named Psyche in the rocky belt between the orbits of Jupiter and Mars, which could contain enough gold to make everyone on the planet a billionaire. Psyche, discovered by the Italian astronomer Annibale de Gasparis in March of 1852 from Naples, and the astronomer named his find after the Greek mythological figure Psyche. It's one of the 10 most massive objects in the asteroid belt. So it's obviously enormous, relatively speaking. And at over 200 kilometers in diameter, it contains a little less than 1% of the mass of the entire asteroid belt. So obviously it carries some weight there too. Most important to our discussion here, though, Psyche is thought to be the exposed iron core of a protoplanet and is the most massive metallic M-type asteroid. If you know anything about the molten metal core of Earth, you will not be surprised to imagine what Psyche could possess, as astronomers have measured and estimated its density to be consistent with that of other metallic asteroids. According to radar and other sophisticated observations that they use, Psyche appears to have a surface that is 90% metallic, and scientists think that these metals are mostly iron and nickel. And this is where the speculation arises that its potential abundance of dense metals could also consist of sizable amounts of gold and platinum. One estimate is that Psyche, roughly the size of West Virginia, contains over 5,000 quadrillion dollars. That's $50,000 trillion of gold at current prices near $1,500 an ounce. All right, so just imagine that. I mean, we're talking about tons and tons of gold, and to be worth $50,000 trillion. So you might be asking yourself, what if a space-based mining mission were set up on Psyche that could start bringing back tons of new gold? That amount of new supply would certainly put a dent in gold prices, now wouldn't it? Well, don't worry, gold investors, because that's a long way off. Oh, wait. NASA just called and said, hold my Krugerrand. Why? Because there's a mission to Psyche in 2022 that will get there by 2026. It'll only take 4 years, less than 4 years to get there. This is the description from the NASA page about the Psyche mission. Astronomers on Earth have studied 16 Psyche. They give it a number now. These different asteroids. They used to give them a symbol, but now they put a number before the name too. So it's officially called 16 Psyche. So they've studied 16 Psyche in visible and infrared wavelengths, as well as radar, which suggests Psyche is shaped somewhat like a potato. Observations indicate that its dimensions are 173 miles by 144 miles by 117 miles. So, and those measurements are where I took my cue to compare Psyche's size to West Virginia at 2,400 square miles, which is 173 times 144 is like almost 25,000 square miles. But West Virginia gives you about an idea of just like if you were looking at one side of the potato, and then you're still talking about a thickness of 117 miles. So this is like the size of West Virginia on one side, but then 117 miles deep. All right. Psyche takes about 5 Earth years to complete one orbit of the sun, but only about 4 hours to rotate on its axis and complete its own Psyche day. Since scientists wonder whether Psyche could be an exposed core of an early planet that lost its rocky outer layers due to a number of violent collisions billions of years ago, they are extremely curious to begin the first mission to investigate a world of metal rather than of rock and ice. Because this will give them like a glimpse back in time about tell them about how planets are formed. We cannot see or measure Earth's core directly, and so this mission will offer a window into the violent history of collisions and accretion that created terrestrial planets. Because when you think about it, if you kind of imagine the Big Bang theory of this massive explosion of matter, and as things cool down and slow down, they begin to gravitate around each other, and obviously magnetic metals are attracted to each other, and this creates the formation of asteroids, which could then coalesce into a planet and that sort of thing. So this is the asteroids will offer a look back in time. All right, more from the NASA website here. This intriguing asteroid is now the primary target of the Psyche mission. Targeted to launch in August of 2022, the Psyche spacecraft would arrive at the asteroid in early 2026, following a Mars gravity assist in 2023. Over 21 months in orbit, the spacecraft will map and study 16 Psyche's properties using a multispectral imager, a gamma ray and neutron spectrometer, a magnetometer, and a radio instrument for gravity measurement. The mission's goal is, among other things, to determine whether Psyche is indeed the core of a planet-sized object. Now, it sounds like, the Psyche mission ship will not actually land on the asteroid. It can do a lot of this measuring just by orbiting it. So they're not going to, in 2026, they're not going to be mining gold from it. But that doesn't mean somebody else isn't thinking about it. Obviously, NASA's scientific mission has priorities that have nothing to do with finding and mining precious metals. But that doesn't mean commercial space explorers haven't been chomping at the booster rocket to set foot on some metals-rich rocks. after asteroid ownership was made legal for U.S. companies in 2015. But the only firm with any reasonable shot at participating in the future might be Elon Musk's SpaceX. And not just because the Tesla founder is well-funded and bold, as we learned from the 2016 book by space exploration pioneer Peter Diamandis. In bold, Diamandis profiled the extraplanetary visions of Musk, Richard Branson of Virgin Galactic, and Jeff Bezos with Blue Origin. But Musk is the first to begin mastering a key technology essential for landing on outer space asteroids with his Falcon Heavy rocket craft that can also return to Earth's atmosphere and land. Martin Elvis, an astronomer for the Harvard-Smithsonian Center for Astrophysics, spoke at the American Association for the Advancement of Science annual meeting in Austin, Texas in 2018, and told the audience that he believes Falcon Heavy has the potential to make asteroid mining a significant commercial reality by increasing the number of asteroids that could be landed on by an order of magnitude. According to Ryan F. Mandelbaum, writing for Gizmodo in 2018, Elvis said of Musk's rocket technology, instead of a few hundred, we may have thousands of ore-bearing asteroids available. So that's pretty exciting. And that obviously gets gold miners and space explorers excited. We may not see the first ounce of gold from outer space for another 10 years or more. But when we do, it could be cataclysmic for the price of the yellow metal. Just imagine that amount of supply starting to flow back to Earth. Because once somebody brings the first few ounces, then it's just a matter of time before there will be a gold rush into space to these asteroids, and people trying to capitalize on the price of gold. Although those missions have to be pretty expensive. I mean, if right now it costs, let's say it costs a gold miner in the desert Southwest or up in Canada, roughly $750 to mine and end up with a finished ounce of gold, I think it's going to cost a lot more to get the gold from asteroids. But let's not talk about that gold anymore. Let's talk about a different kind of gold. So this is, I'm continuing reading from my article last week on why gold is headed to zero. The journey to Alnilam. So let's talk about that industry that was up, 15% in the last few months and handed my healthcare innovators portfolio gains of 50 to 75% in stocks like CRISPR Therapeutics and Unicure, which is a Dutch company developing a treatment for hemophilia. That industry is obviously biotechnology, and I think it will create more millionaires than investing in gold in the next decade. So I wrote a report last year that I constantly revise, and it's called The Century of Biology. And one of my favorite investments is CRISPR Therapeutics. The stock was up 50% in a few weeks after they released some data on some of their first tests in treating sickle cell disease and beta thalassemia. We just sold CRISPR this week for over 80% gains because, when I get an 80% gain in a few weeks, we like to take it, even though our healthcare innovators portfolio is designed to have a longer-term view. And that's why, obviously the biotech industry, when I say the industry was up 15%, I'm looking at an ETF like the NASDAQ Biotech Index, when the symbol there is IBB, one of the best ways to invest. But that one is cap-weighted, and if you're looking at other ways to invest in biotech, and you want to capture the gains of the smaller companies like a CRISPR, so you get exposure to the small caps and the $1 billion, $2 billion, $3 billion, $4 billion companies. Then you can buy the equal weighted S&P Biotech ETF, whose symbol is XBI. All right, and so what else was moving? I've got another stock that's up really big in the past few weeks, and that's Global Blood Therapeutics, GBT, because they got accelerated approval to treat sickle cell from the FDA. And then there's Alnylam. And I forget if I'm pronouncing this right. The name of the company is spelled Alnylam. And it actually takes its name from a star, a gigantic super star named Alnylam that is spelled a little bit differently. It's spelled with an I instead of a Y. So Alnylam. That stock is also up 50% since mid-October after receiving its second FDA approval to treat a rare genetic disease using RNA interference therapies. I first identified Alny, ALNY, as the stock symbol, as a promising biotech investment in 2013 when it was trading under $30. It is, it has quadrupled to nearly 120. So, and we didn't catch that whole gain. I sold it too early back in 2013 and 2014, but we got back in the stock at 80 just a month ago. So very happy there. As I said, Alny is named after Alnylam, a large blue supergiant star some 2,000 light years distant in the constellation Orion. It is estimated to be 275,000 to 832,000 times as luminous as the sun. So, all right, so those are some big numbers there, 275,000 times. So up to 832,000 times. Let's just call that, let's just round that or average that to 500,000 times as luminous as the sun. I mean, can you even imagine that? Like our sun is plenty luminous as it is, and that's because this large blue supergiant star is 30 to 65 times as massive. So our sun is enormous, but imagine something that is 40, 50 times larger and would give off 500,000 times as much light. I mean, it's just incredible to think about. Well, it's 2,000 light years away, so we won't be traveling there anytime soon and feeling its heat or light. But in the time it takes the NASA mission to land on Psyche, Alny shares could quadruple again. And you won't get that from gold in the next 7 years. So that's my, that's my thesis in a nutshell. Why what you should buy instead of gold is to learn to invest in biotechnology. And I don't tell people to run out and just start picking biotech stocks. I say, look at the ETFs. At least invest in the ETFs, and then you learn you have this low risk exposure because you don't have company specific exposure. So if the FDA tells a certain company, no, go back to the lab, this drug will never work, or you killed some patients, that's going to hurt that company, but it's not going to take down the whole basket of stocks. Whereas one company stock could get cut in half or go to zero, that's never going to happen to the whole group. So that's why I talk about, learn about the companies by investing in the ETFs, learn about the companies, and as you learn more, then you may decide you want to invest in a particular biotech company. The engineer who runs my podcast here, Danny, I sat down with him and Eric, our videographer, in their Paper Traders show. It's more than a podcast because they do it on video and it's on YouTube. But and we did that a few weeks ago, or a couple months ago, and they wanted to do something on healthcare, and that was my biggest theme: is to tell everybody just go out and pick one of these biotech ETFs where you have low risk exposure to one of the most important bleeding edge industries, that will continue to astound and amaze you over the next 10, 20, 30 years, and you want to be invested there. So you could I call it the century of biology. What's cool is that, it's happening right now. This genomic revolution. I mean, whenever I talk about the century of biology or the prospects for genetic and cell therapies, I tell people they should be excited because they're living right now in the middle of this revolution. I mean, since they cracked the genome in the early 2000s, there's just this flood of companies doing different R&D to either cure disease or treat a disease, and there will be no end to this for decades. And we're watching this revolution as it happens now. So it's fun to be an investor in it. I recommend everybody pick a biotech ETF and just buy a little bit of it, and then do a little homework. Look at what are the companies in it. Just whatever the ticker is for your ETF, and I'll give you a couple more. Then you can see the top holdings. So even if you don't have capital to invest or time to research the companies, the research and discoveries being made are world-changing. There will always be ethical challenges with gene editing and the costs associated with advanced therapies. But I mean, I always tell people, don't you want to be part of that conversation? Don't you want to be educated enough to even have a conversation about gene editing, so that where it's good, where it's bad, where it's applicable, where you want to vote for a member of Congress who may be for gene editing or against it, and know what kind of future you're helping create. So there's always going to be, the incredible wonder to behold on the bleeding edges of science. The plea I always make to biotech investors is just, is learn about these companies. Another one is there's a new fund family called ARK Innovation, ARK Innovation, and they have a couple of ETFs that are focused on healthcare, just like my portfolio here, Healthcare Innovators. And the ARK Genomics ETF, symbol ARKG, it holds some of the CRISPR stocks, and then it holds the companies that create sort of the tool bench, or the laboratory, so to speak, to do genomic sequencing. So like an Illumina or an Invitae, and these are the companies. So if you've ever done a genomics thing with Ancestry or 23andMe, the technology behind those tests is built by an Illumina or an Invitae. All right. So again, if you learn about these ETFs, if you buy one and then you look up the top holdings, then you start to learn about the companies. It accomplishes at least two things. First, you're already invested in the industry with very low risk, and second, you expose yourself to learning about the top science and the top companies. Or I should say, I hope you at least become curious about them, because becoming more curious about science and technology is never a bad thing. And in fact, I would argue that it's a very necessary thing in the next few decades. One of the most interesting presidential candidates right now, I think, is Andrew Yang. And I'm not saying I'm voting for him or supporting him. I just think he has the most vision when it comes to technology, because he is looking out in ways that I've done recently in some of my podcasts about where technology is going with advanced AI technologies and biotech, and how fast that will change the world, and what we need to do to be ready for it, in terms of education and also in terms of economics. So I tell people, Yang really understands the power of technology like AI, automation, and things that are going to drastically change the world, and how important education will be. In the article version of this podcast that will appear on Zacks.com, I'll also link to some of the podcasts that I've done on this theme. One of them is titled "What to Do Before the Machines Take Over," and then I even did a thing last year on Facebook. I called it "Facebook Faceplant: The First AI Failure and More to Come." So people may not agree with Andrew Yang's freedom dividend, which is a proposal along the lines of universal basic income, where every citizen would receive a monthly check for $1,000. But after you listen to my podcast and read my articles about what is coming with artificial intelligence and other advanced technologies that the rich and powerful will control, you might pay more attention to what we're saying. And this is along the lines of the historian Yuval Noah Harari, who wrote Sapiens and then wrote the book Homo Deus. In Homo Deus, he paints sort of a dark dystopia where he imagines one future is where the rich and powerful will be able to afford all sorts of biological and neurological enhancements, whether from artificial intelligence chips or gene editing, and the rest of us will be sort of inferior while they're turning themselves into super beings. So he's not saying that this is the direction all this technology has to go, but as a historian, he looks at what usually happens with technology and wealth, and their concentration, and especially with advanced technologies, who can afford them, who can control them, and so that's my plea, to get as educated about these technologies as we can. All right, so what's more fun than talking about science and technology? Making money with them. And you do that by putting less money in gold or no money in gold and investing in companies like NVIDIA or CRISPR. All right, thanks for joining me once again on Mind Over Money, and I will see you on the other side of the future.
This material is being provided for informational purposes only, and nothing herein constitutes investment, legal, accounting, or tax advice, or a recommendation to buy, sell, or hold a security. Do not act or rely upon the information and advice given in this podcast without seeking the services of competent and professional legal, tax, or accounting counsel. Publication and distribution of this podcast is not intended to create, and the information contained herein does not constitute an attorney-client relationship. No recommendation or advice is being given as to whether any investment or strategy is suitable for a particular investor. It should not be assumed that any investments in securities, companies, sectors, or markets identified and described were or will be profitable. All information is current as of the date herein and is subject to change without notice. Any views or opinions expressed may not reflect those of Zacks Investment Research as a whole.